I'm John Kosar from Asbury Research, and this is the Asbury Approach to Investing video for November 2022. You can subscribe to these videos below. This is actually a very small subset of a much larger and more detailed monthly report, one of many that we produce throughout the month and throughout the year for our paid subscribers. The purpose of these free monthly videos is to introduce professional and private investors to our unique data-driven approach and quantitative models. All Asbury Research reports and models answer two primary questions. Number one, should I be invested and how much? Number two, which parts of the market should I be invested in? So let's begin. This first slide is a little bit about me. This is my 42nd year in the business. I started as a runner on the floor of the Chicago Mercantile Exchange back when there was open outcry trading. Back in the early 1980s when I was in my early 20s. I stayed there for 17 years, and that was my college. That basically showed me how financial markets work in a very practical way. I started as a runner. When I left the floor, I was a floor analyst for several major banks. I was filling orders in the pit, and I was helping investors around the world to trade markets better. What we do, more importantly, is we try to simplify what we're looking at to do in the markets. We're not trying to forecast the markets or pick who's going to win the election and what the CPI number might be and all this three-dimensional chess that goes on. It's very difficult to do, and the answer is nobody knows. It hasn't happened yet. So what we do is we follow the data. We're strictly data-driven. We are following the data through various methods and models that we've built, following the data around the financial markets, trying to get on new trends in their very early stages, and then trying to get off of those trends with as much profit as possible. So basically, when it's time to be aggressive and fully invested, we call that risk on. When it's time to be defensive and protecting your capital, we call that risk off. Which parts of the U.S. financial landscape are performing the best? Ideally, when the market's going up, we're in the parts of the market that are outperforming the S&P 500. Which sectors, industry groups, and individual stocks to buy? Where the opportunities lie in global financial markets, and where the best opportunities exist in a broad array of ETFs, which also give us exposure to interest rates and many of the commodity markets. Our data-driven models, we have 6, and we're always working on building more models. Our CPM, or the correction protection model, is our oldest model. I built that over 10 years ago at the request of a number of RIA and money manager clients that we had that wanted a simple binary tool that would tell them when to be risk on and when to be risk off, when to be putting new money to work and when to be tightening stops and pulling back from markets. And they wanted to do that in such a way so their older, wealthier, and more risk-averse clients could participate in the stock market with a lot less risk. Our Asbury 6 model is for risk management, and that is updated every day in our research center. And the purpose of that is to let us know the day-to-day internal health of the market, because you really can't tell by looking at the S&P 500 anymore because it's up 100 today and down 75 tomorrow. This is the equivalent of what your doctor does when you walk into the doctor's office and he has that battery of tests that he takes right off the bat and checks your pulse, checks your blood pressure, checks your reflexes. This is what the Asbury 6 does for the market. Our SEAF model, SEAF stands for sector ETF asset flows, and that's for sector selection. We do that by following the money around the 11 sector spiders, which together is the S&P 500. Our CARP model, CARP stands for cross asset relative performance. That's for domestic asset allocation. That tells us which markets to be in for the best performance, which parts of the market. Our US versus the world is for global asset allocation. And finally, our sector and industry group momentum model really focuses mostly on industry groups and tells us where the performance is. Let's look at CPM first. We talked about CPM. It was designed to protect investor assets, eliminate large drawdowns, and reduce volatility in portfolios. So we are currently risk on according to the CPM model. We are risk on as of October the 25th. You can see that green arrow right here at the lower right edge of the chart. And these are our signals over the past year. Typically moves about 5 times a year. Again, it's binary. It's either risk on or it's risk off. When we built CPM, we built it for, again, trying to lower the risk. Let older, wealthier, more risk-averse investors play the game with a lot less risk. So you can see, back tested since 2011, CPM has underperformed the S&P on average by 1.7% a year. You might ask, why is that good? It's good because it does that with a beta of 0.44 versus a beta of 1.0 for the S&P. That's the standard. That's the bogey. So according to beta, less than half the risk. According to maximum drawdown, the maximum drawdown during this period for CPM, following the CPM signals, is 15%, where the S&P 500 is 34, for less than half the risk. And look at the standard deviation, only 8.9% for trading the CPM signals using SPY versus 14.3 for the S&P 500. The next thing that we did, just to understand how the model works better, is we said, what happens if we build some of that beta, some of that risk back in to the model? So we back tested again since 2011 and through the third quarter of this year, just as we did in the first column here. We used a 2 times leveraged ETF, the SSO. And what we found is we are now outperforming on average by 6.3% a year. And what that does is it raises the beta up to 0.88, still a little bit less than the S&P at 1. It takes our maximum drawdown to 29.5%, still less than the 33.9% for the S&P 500. So a couple of different ways to look at the CPM model. Our Asbury 6 tool went back to positive about a week earlier on October the 18th. So you can see that we caught this pretty early, caught this rally pretty early. It is still positive. So both our CPM and our Asbury 6 models have had us back in the market in the middle to latter part of October. Another feature of the Asbury 6 is when it starts to blink. We call it blinking when it starts rapidly moving from red to green, from down to up. You can see it did that from the end of November of last year through the beginning of this year. That told us that this was a top here. That told us, it didn't tell us when the top was going to begin or how deep it was going to go, but it told us not to bite on that new high that we made on January 4th, because this was telling us the market was in transition. We had a similar one back at the June and July lows. We had more blinking that told us that we were probably going to get a good rally. The Asbury 6 is currently all green or all bullish. All of them are positive right now. These are the dates in the individual cells that each of the 6 of these constituent metrics all turn positive. Only one of them has to do directly with the S&P. It's its rate of change. The other 5 are what I would call secondary indicators. Stocks versus high yield bonds in relative performance terms, investor asset flows, corporate bond spreads, trading value, market breadth. That keeps us from biting on these erratic moves that you see in the S&P 500 and keeps us looking under the hood at the market so we know what its condition is every day. Here's a chart of the S&P. So you can see basically from the middle of October through the latter part of October, right where I'm circling, is where we went back to a positive risk on in both the Asbury 6 and in CPM. On October the 24th, we actually broke out of a pattern, an inverse head and shoulders pattern that targets a move up to 40.25. We're closing in on that right now. Major resistance is right around 4,100. We've got the 200-day moving average here, and we've got the low from back in February of this year, right around 4,100, and our minor support is currently at 3,790. A couple of indicators that don't have anything to do with our models but are very important right now have to do with investor sentiment. Since the beginning of the summer, we were talking about the 3,600 level in the S&P 500. You can see it right here, 3,600 level in the S&P 500 as being a probable strategic bottom, one to several quarter bottom in the S&P. The reason was because two of our sentiment indicators here were at least bullish extremes. The one that really was compelling to us is the investors' intelligence data, which is here on the right. On June 17th, it bottomed, started to move higher, and then it did again on October the 7th. And if you look across this chart going all the way back to 2010, each other time that it got down to this extreme, least bullish extreme, those were really important bottoms in the S&P. So March 2020, which was a COVID low, January of 2019, March of 2016, SEP of 2011, SEP of 2010. That told us that the next time that we got a risk-on situation in our CPM and in our Asbury 6, we should pay attention to it. So we did, and when they turned positive in the middle of October, we aggressively were putting money back into the market because we had these indicators to lean on. Here's some ETF asset flows data. This is tactical. Tactical for us is 21 days. Strategic for us is 63 days or greater. So this is a tactical tool for us. And since November the 9th, look at this money flow going back into the QQQ, which is the ETF that tracks the NDX. That shows investor day-to-day conviction, overnight conviction that the market is bottoming and going higher. Note that the last time that we turned up above the 21-day moving average like we're doing now was back here in July and August, which gave us this big rally. If we start getting outperformance from the technology space, that is going to help this current rally that we have stick and take us through the end of the year and possibly into next year. Here's our CART model. Our CART model is currently, it basically looks at 8 different equity-related relative performance comparisons. Stocks or bonds, high beta stocks or low volatility stocks, large cap or small cap, growth or value, the S&P versus the Dow, the S&P versus the NASDAQ. It tells us whether we're in a risk-on or risk-off situation, and it tells us where the outperformance is. Right now, this outperformance is leaning negative, with the exception of small cap. Small cap looks like an opportunity to us according to our model. This is our US versus the world model. Note all the outperformance here around the world. This is a relatively new thing that we've seen, new trends. As the S&P 500 was really beaten down over the past month or so, you saw a lot of outperformance coming from other places in the world. We're going to be very interested to see which of these stick as the S&P 500 strengthens. Again, this helps us to, many managers like to take a small portion of client portfolios, diversify them overseas. This shows where that performance is. This is our SEAF model, our sector ETF asset flows model, and it shows us currently through the end of last week, the money is going into financials. We've got a trend all the way across 3 different time frames, trading, tactical, and strategic, that tell us the money is going into financials. That's why it's green, positive, and it's showing us that in the tactical and strategic time periods, consumer discretionary is where the money is coming from. Here's a little performance on SEAF. Going back over the past 9 quarters, it has outperformed the S&P by 7 of them. All of the green are outperformers, and the 2 red ones are underperformers. So it's outperformed the S&P 500 7 of the past 9 quarters. It's done that with a slightly lower beta, a beta of 0.89 versus 1, of course, for the S&P, and a maximum drawdown of only 22.5% versus 25.2 for the S&P. And note that the annualized total return during this period is almost double, 19.2 for SEAF versus 10.1 for the S&P 500. And finally, here's what the chart looks like going back over this 9-quarter time period. The SEAF is green, the green line, and the S&P 500 is the blue line. You can see that CEF overtook. You can see the wiggles are generally the same. CEF overtook the S&P 500 early part of 2021 and has stayed there. This is this year. Right here, what I'm blocking off with my mouse is this year. You can see while our market, or while the S&P 500, the broad market, had a horrible first 3 quarters, CEF stayed very firm. And it did finally roll over a little bit, but still way ahead of where the S&P is, almost double of where the S&P 500 is, actually about double. The reason it did that is CEF had us in the energy sector for almost the entire first half of this year, which protected us from those very large losses. So there you have it. This is just a brief overview of what we do. You can get further information about us by phoning us, 888-960-0005, sending us an email, or visiting us at asburyresearch.com. You could also ask for a PDF of this entire report via any of these contact points. Thanks for listening, and we'll see you next month.